Hey everyone, welcome back. Today we're breaking down how to invest like Warren Buffett, step by step, in detail. We're not just talking about what he buys, we're diving into how he thinks, how he decides, and how you can apply it to your own investments, even if you're not a billionaire. If this helps you out, do me a quick favor, tap that like button and subscribe. It tells YouTube this is worth sharing and helps more people build smart investing habits. All right, let's jump in. Let's start with a question. Why Warren Buffett? Because he's arguably the greatest investor of all time. He turned a few $1,000s into hundreds of billions through consistent, disciplined investing. And he didn't invent anything. He didn't ride a bubble. He just applied simple principles over a long time. He buys businesses, not stocks. He stays rational. He waits for the right pitch. And that's something anyone can learn from. So let's break down his approach into actionable steps. We're going deeper than just value investing. Step 1. Mindset. This is where everything starts. Buffett always says, the stock market is a device for transferring money from the impatient to the patient. Most people lose money not because they pick the wrong company, but because they panic, chase hype, or sell at the worst time. Buffett's edge isn't just in analysis, it's in temperament. He stays calm when others are freaking out, and he doesn't get greedy when prices soar. He's often quoted as saying, "Be fearful when others are greedy, and greedy when others are fearful." That mindset is hard to master, but it's essential. You can't copy his portfolio if you can't copy his patience. Step 2, think of stocks as ownership in businesses. This is one of the biggest mental shifts. Buffett doesn't think of stocks as pieces of paper. He thinks of them as partial ownership in real companies. Would you buy the entire business if you could? Would you still want to own it if the market closed for 10 years? That's the test. If the answer is yes, you're probably looking at a good investment. It also helps you zoom out. You stop obsessing over daily price moves. You focus on long-term value. So before buying a stock, ask, do I understand what this company does? Would I be proud to own it for years? That leads us to step 3. Stay within your circle of competence. Buffett has said many times, you don't have to be an expert on everything. Just know your circle and stay inside it. If you don't understand a business, don't invest in it. That's why he avoided tech stocks for years. Not because they weren't valuable, but because he didn't understand how they made money at the time. Now, that changed when Apple came along. But even then, he waited until the company was making reliable profits and building a strong ecosystem. It's about clarity, not complexity. If you can't explain the business model in a few sentences, it's probably outside your circle. Step 4. Look for durable competitive advantages, what Buffett calls economic moats. This is huge. It's not enough for a business to be good today. It has to stay good for decades. So what protects it from competition? Buffett loves businesses with strong brands, like Coca-Cola, or ones with network effects like American Express or Apple. He's said, the key to investing is not assessing how much an industry is going to affect society, but rather determining the competitive advantage of any given company. So look for moats, patents, brand loyalty, cost advantages, switching costs, anything that keeps competitors out. A great product isn't enough. A moat keeps the profits flowing. Step 5, management matters. Buffett bets on leadership. People who are smart, ethical, and shareholder-friendly. He loves businesses where managers act like owners, where they reinvest wisely, communicate honestly, and don't waste money. He avoids companies with flashy CEOs chasing short-term gains. He wants rational capital allocators, people who know how to spend, save, or return money to shareholders wisely. Before investing, read shareholder letters. Listen to earnings calls. Get a sense of how management thinks. Do they focus on long-term value, or do they hype every quarter? Buffett has always admired people like Tom Murphy, Bill Gates, and Tim Cook. Quiet, competent, focused. Step 6, learn to calculate intrinsic value. This is the heart of value investing. Buffett doesn't just buy cheap stocks. He buys businesses worth more than their current price. So how does he know what they're worth? He estimates future cash flows and discounts them back to present value. That's called a DCF, discounted cash flow analysis. Now, you don't need a PhD to do this, but you do need to think in terms of future earnings. What will this business earn over time? How predictable is that income? What's a fair return for the risk? And then, this part's key, you don't buy unless the stock is trading below that value. That's your margin of safety. Step 7, always demand a margin of safety. This is one of Buffett's core principles, borrowed from his teacher, Benjamin Graham. If you think a stock is worth $100, don't buy it at $98. Wait until it's 70s or even 60. Because if your estimate is wrong, and it will be sometimes, the discount protects you. It gives you a cushion, a safety net. The market is unpredictable. Your assumptions might be off. The world can change. But if you buy at a big enough discount, your downside is limited and your upside is solid. This is why Buffett rarely chases stocks. He waits. He's happy to hold cash for years until the right deal comes along. He once said, "The stock market is like a bar. Every day, Mr. Market offers you a price. You don't have to dance with him unless it's a great offer." Step 8. Be patient. This cannot be said enough. Buffett's success comes from making a few great decisions and holding for a long time. He held Coca-Cola for decades. He's held Apple since 2016, and it's now one of Berkshire's largest positions. He doesn't jump in and out. He buys quality and he holds. He said, "Our favorite holding period is forever." You don't need 100 trades a year. You need 5 or 10 smart ones in your lifetime. Step 9. Don't try to time the market. Buffett doesn't guess where the economy is going. He doesn't try to predict recessions. He just looks for great businesses at good prices and buys when the math makes sense. He said, "The only value of stock forecasters is to make fortune tellers look good." So ignore the noise. Ignore the headlines. Focus on fundamentals. Step 10. Keep your personal finances solid. Buffett hates debt. He says, "If you're smart, you don't need it. If you're dumb, it'll ruin you." He doesn't use leverage to boost returns. He avoids margin. He keeps cash on hand so he can pounce when others are selling. You should do the same. Don't invest money you'll need soon. Don't borrow to invest. Build a cushion. And when the market drops, that's your opportunity. Step 11. Read constantly. Buffett reads 5-6 hours a day. Books, annual reports, newspapers, trade journals. He once told a group of students, "Read 500 pages like this every day. That's how knowledge builds up." You don't need to match that, but aim for consistency. Read annual reports. Learn accounting basics. Study companies you admire. The more you know, the better your instincts. Step 12. Avoid complexity. Buffett doesn't touch crypto, derivatives, or high-frequency trading. He sticks to simple businesses with understandable models and solid cash flow. His rule? If you can't explain it to a 12-year-old, don't invest in it. Step 13. Think long-term. Buffett doesn't care what the stock does next week. He cares about where the business will be in 10 years. He says, "Someone's sitting in the shade today because someone planted a tree a long time ago." So invest in businesses with staying power. Think decades, not quarters. Step 14. Tune out the noise. Buffett doesn't watch CNBC. He doesn't care what analysts are saying. He makes his own decisions based on the numbers. The market is full of opinions. You don't need more opinions, you need clarity. Do your own work. Don't outsource your thinking. Step 15. Know when to say no. Buffett sees thousands of investment ideas every year. He says no to almost all of them. He's patient. He's picky. He waits for great businesses at great prices. He says, "The difference between successful people and very successful people is that very successful people say no to almost everything." Step 16. Focus on what won't change. Buffett likes businesses with predictable demand. People will still drink Coke, still use insurance, still need banking. He avoids trends that come and go. He bets on human behavior staying the same. Ask yourself, will this product still be relevant in 20 years? If the answer is yes, dig deeper. Step 17. Reinvest intelligently. Buffett doesn't chase dividends just for the yield. He cares how a business reinvests profits. Does it grow earnings efficiently? Does it buy back shares wisely? Does it make smart acquisitions? Capital allocation is everything. Study how a company uses its cash. Step 18. Learn from mistakes. Buffett writes about his mistakes in every shareholder letter. He's made some big ones. Buying Dexter shoe, buying airlines too late, passing on Google. But he learns. He adapts. He gets better. That's what matters. Progress, not perfection. Step 19. Stay humble. Buffett always gives credit to his team, his mentors, and his partners. He doesn't brag. He keeps learning. Investing rewards humility. The moment you think you can't lose, you usually do. Step 20. Be ethical. Buffett has built trust over decades. He does business with a handshake. He says, it takes 20 years to build a reputation and 5 minutes to ruin it. So act with integrity, in investing and in life. If you follow these steps, not just what Buffett buys, but how he thinks, you'll build real, lasting wealth. Won't be fast, but it'll be steady and solid and earned. If you made it this far, thanks for watching. If this helped you, hit that like button and subscribe for more. We've got more deep dives like this coming, so stick around. And remember, invest smart, stay patient, and think like Buffett. See you in the next one.